Something fundamental has shifted in the financial system. If you've been watching gold and silver, you already know what I'm talking about. If you haven't, what I'm about to share may change how you think about your financial future. Gold recently crossed territory it hasn't seen in years. Silver is moving with a velocity that catches even experienced traders off guard. But this isn't about celebrating price movements or calling tops and bottoms. This is about understanding what these moves are telling us about the system itself. I'm not here to sell you anything. I'm here to help you understand what's happening, why it matters, and how thoughtful people are responding. Whether you own these metals or not, the forces driving these markets affect every currency holder, every saver, every person planning for their financial future. The truth is, most people will miss what's really happening. They'll see headlines, maybe feel some excitement or fear, and then move on. But the investors who understand this moment, who grasp the deeper mechanics at work, are positioning themselves very differently than the crowd. So let's walk through this together calmly and clearly. By the end of this discussion, you'll understand the macroeconomic forces behind this move, what history teaches us about similar periods, and most importantly, how to think about your own situation with clarity and discipline. This is not financial advice. I'm not your advisor. But I am someone who has studied these cycles, watched these patterns, and learned that understanding beats reacting every single time. Let's start with what's actually different right now. For the past several years, we've been living in an extraordinary monetary experiment. Interest rates went to zero, then negative in some countries. Central banks printed trillions in new currency. Governments expanded their debt at rates that would have seemed unthinkable just 2 decades ago. Many people assumed this could continue indefinitely. Markets adapted. Investors learned to buy the dip because central banks always stepped in. Risk seemed manageable because policymakers had demonstrated their willingness to support asset prices. But something changed in recent months. The relationship between currency creation and real economic productivity has stretched to a point where even mainstream institutions are acknowledging the tension. Gold doesn't surge like this in a healthy, stable monetary environment. Silver doesn't make these kinds of moves when investors have full confidence in the purchasing power of their currency. These are not speculative assets catching a trend. These are monetary metals responding to monetary stress. Look at what's happening beneath the surface. Government debt levels in major economies are approaching or exceeding levels previously seen only during major wars. The cost of servicing this debt is consuming an increasingly large portion of government budgets. The mathematics of this situation are not complicated, but the implications are profound. At the same time, the tools that central banks traditionally use to manage economic cycles are constrained. Raising interest rates meaningfully would make debt service unsustainable. Keeping rates low allows inflation to erode purchasing power. This is the corner they've backed themselves into. Sophisticated investors recognize this environment. They understand that when the options narrow, when the path forward becomes less clear, when monetary authorities face impossible trade-offs, hard assets tend to reflect that reality. This is what you're seeing in gold and silver right now. Not speculation, not a bubble. A recognition that something fundamental about the monetary system has reached a critical point. Here's what most people get wrong about precious metals and why that misunderstanding matters right now. Many view gold and silver as investments, things that should produce cash flow or earnings growth. But that's not what they are. They're not companies. They're not bonds. They're forms of money that have held value for thousands of years, regardless of which government was in power or which currency was being printed. When you hear someone say gold produces nothing, they're technically correct, but completely missing the point. Gold isn't supposed to produce anything. It's supposed to maintain purchasing power when other forms of money are being debased. That's its entire purpose. Silver carries a dual role. Yes, it has industrial applications that gold doesn't have to the same degree, but it's also historically served as money, and it responds to monetary stress, much like gold does, often with greater volatility. The mainstream financial education most people receive teaches them to focus on stocks and bonds, on yield and growth. There's nothing wrong with those assets in the right context, but that education often completely ignores the role of monetary metals in a diversified portfolio, particularly during periods of currency stress. This creates a blind spot. When metals start moving, most people don't have a framework for understanding why. They see volatility and assume speculation. They see rising prices and think, bubble. They fundamentally misunderstand what these markets are signaling. Right now, that misunderstanding is causing many people to dismiss or ignore moves that experienced investors consider deeply significant. While headlines might mention gold hitting new highs, the commentary often trivializes why it matters. The people who understand this aren't the loud voices on social media predicting the end of the world. They're the quiet allocators, the multi-generational wealth managers, the central banks themselves, who have been accumulating these metals consistently regardless of short-term price action. They understand something essential. In a world of expanding debt and constrained policy options, the historical role of precious metals becomes relevant again, not as speculation, but as insurance, not as a get-rich scheme, but as wealth preservation. Let me explain what's actually driving this market in language that makes sense. First, understand inflation not as temporary price increases, but as the ongoing expansion of the money supply relative to real goods and services. Every dollar, euro, or yen created dilutes the value of existing currency units. This isn't theory, it's mathematics. For years, this expansion was absorbed by asset price inflation. Stock markets rose, real estate appreciated. The inflation showed up in asset prices rather than consumer prices. But that dynamic is shifting. When currency creation outpaces productive economic activity by wide enough margins, for long enough periods, it eventually affects the prices of everything. Gold and silver respond to this because they can't be printed. Their supply expands slowly through mining, which requires real capital, energy, and labor. No government can create more gold by decree. No central bank can expand the silver supply with a policy decision. This scarcity gives them a natural resistance to monetary expansion. As the gap widens between currency creation and real economic growth, metals tend to reflect that growing gap. Now consider interest rates. When rates are below the true rate of inflation, anyone holding cash or bonds is losing purchasing power. The nominal value might stay stable or even grow slightly, but the real value, what you can actually buy with that money, declines. In this environment, assets that maintain purchasing power become more attractive. Gold, which pays no yield, starts to look more competitive with bonds that pay 3% while inflation runs higher. The opportunity cost of holding gold decreases when the alternative is guaranteed purchasing power loss. Debt dynamics matter enormously here. Global debt levels, both government and private, are at historic highs relative to GDP. This debt was manageable when interest rates were near zero. But as rates rose even modestly, the cost of servicing this debt became a significant burden. This creates a trap. Governments need to continue spending to maintain social stability and economic growth, but higher rates make that spending more expensive. The pressure builds to keep rates lower than economic fundamentals would normally dictate. The pressure builds to eventually create more currency to manage the debt load. Investors who study history know how this movie tends to end. Not with sudden collapse, usually, but with gradual currency depreciation, with inflation that's higher and more persistent than officials claim, with a slow but steady transfer of wealth from savers to debtors, from currency holders to hard asset owners. Currency pressure is perhaps the most direct driver of metal prices. When confidence in a currency weakens, when people question whether their dollars or euros will buy as much next year as they do today, they look for alternatives. For thousands of years, that alternative has been precious metals, not because of tradition or superstition, but because they've worked. They've maintained value across empires, across currency regimes, across complete political and economic transformations. Market cycles play into this as well. Metals tend to move in long cycles, multi-year periods of strength, followed by multi-year periods of consolidation or weakness. Understanding where we are in these cycles helps investors avoid chasing tops and panicking at bottoms. Right now, multiple indicators suggest we're in the early to middle stages of a significant cycle, not the end. Not the euphoric top where everyone's talking about gold, the phase where informed investors are accumulating, while the majority remains skeptical or unaware. Investor psychology completes the picture. Markets are driven by human behavior as much as by fundamentals. Fear and greed, confidence and panic, these emotions create the volatility and opportunity in every market. In precious metals, psychology often lags fundamentals. The macro case for metals can be building for years before mainstream investors pay attention. Then, when they finally do notice, the moves can be sharp and sustained as capital flows shift. We may be entering that phase now. The fundamentals have been building. The macro case has been clear to those paying attention. Now price action is starting to reflect those fundamentals, and that price action is drawing wider attention. History doesn't repeat, but it certainly rhymes. Let's look at what similar periods can teach us. In the 1970s, the United States faced a situation with some notable parallels. High debt levels from the Vietnam War and Great Society programs, rising inflation and currency stress as the gold standard was abandoned, energy shocks that disrupted the economy. Gold entered that decade around $35 per ounce. By 1980, it had reached over $800. Silver moved from around $1.50 to over $50. These weren't smooth moves. They were volatile, with significant pullbacks, but the overall trajectory was clear, driven by fundamental monetary dysfunction. The investors who understood what was happening in the early 1970s didn't wait for confirmation from mainstream media. They didn't wait for their neighbors to start buying. They recognized the monetary dynamics and positioned accordingly. Then came the 1980s and 1990s. Paul Volcker raised interest rates dramatically, breaking the back of inflation, but causing severe economic pain. For the next 2 decades, metals languished. Dollar confidence was restored. Debt levels moderated. Inflation was controlled. During those decades, holding gold meant watching stocks and bonds dramatically outperform. It meant being patient, sometimes for years, waiting for the cycle to turn again. Many people who bought at or near the 1980 top endured decades of poor performance. This teaches us something crucial. Timing matters. Even in long-term holding strategies, understanding cycles matters. Recognizing when fundamentals support an asset versus when they don't matters. Then came 2000 to 2011. Dot-com bust, housing bubble and financial crisis, massive monetary intervention. Gold went from around $250 to over $1,900. Silver from around $4 to nearly $50 again. Another major cycle, driven by similar forces we see today: debt expansion, monetary creation, currency concerns. From 2011 to 2015, metals corrected significantly. Sentiment shifted. The financial crisis response seemed to stabilize the system. Stocks recovered. The dollar strengthened. Metals were forgotten by many. But central banks kept buying. Informed investors kept accumulating. Because the underlying dynamics, the debt levels, the monetary expansion, these didn't stop. They just paused, then accelerated further. From 2015 to today, we've seen the monetary experiment expand to levels that dwarf even the crisis response. Debt has exploded. Currency creation has been normalized. The idea that central banks would allow any significant market correction has become embedded in investor psychology. This is the environment in which the current move in metals is occurring, not in isolation, as part of a long-term cycle that responds to fundamental monetary dynamics. The pattern is clear to those who study it. Periods of monetary stability and fiscal discipline are not friendly to gold and silver. Periods of monetary expansion and fiscal crisis are. Which environment are we in today? Look at the debt levels. Look at the deficit spending. Look at the political impossibility of meaningful fiscal reform. Look at the central bank balance sheets. The answer becomes obvious. If you already hold gold and silver, this section is for you. First, understand what you own. You don't own a stock that might go bankrupt. You don't own a currency that can be printed into oblivion. You own physical wealth, forms of money that have survived every empire, every currency regime, every financial crisis in human history. The recent moves validate a decision you made, perhaps months or years ago, to allocate capital to these assets. That validation feels good, but it's also dangerous. This is where discipline becomes crucial. You've held through periods where metals seemed dead, where the mainstream mocked gold as a barbarous relic, where every financial advisor pushed you toward stocks and bonds. You held because you understood something fundamental about monetary cycles. Now that understanding is being reflected in price. Other people are starting to notice. The narrative is shifting. This is not the time to get emotional. Your job now is to remember why you bought in the first place. If you bought as insurance, as a hedge against currency debasement, as a store of value during monetary uncertainty, those reasons remain valid. In fact, they're becoming more relevant, not less. This doesn't mean hold forever regardless of circumstances. It means stay anchored to your original thesis. If that thesis was long-term wealth preservation, short-term price moves, even significant ones, shouldn't change your strategy. Some questions to ask yourself: what allocation percentage did you target? Are you there? Has the recent appreciation pushed your metals allocation above your target range? If so, rebalancing might be appropriate, not because the bull market is over, but because maintaining target allocations is sound portfolio management. Are you holding physical metal or paper proxies like ETFs? Physical metal provides the monetary insurance that's most relevant during system stress. Paper claims work well in normal times, but introduce counterparty risk precisely when you'd most want to avoid it. Have you secured your holdings properly? Physical security, privacy, and access all matter. The asset does you no good if it's vulnerable to theft or inaccessible when you need it. Are you talking about your holdings publicly? This is generally unwise. The people who successfully maintain wealth across generations tend to be quiet about their holdings. There's no benefit to broadcasting your positions, and several potential drawbacks. For current holders, the most important thing is emotional control. The excitement of rising prices can lead to overconfidence. The temptation to add at higher levels because of momentum can undermine your average cost basis. The urge to check prices constantly can create anxiety that serves no purpose. You made a strategic decision based on long-term fundamentals. That decision is playing out. Now your job is to stick to the plan, maintain discipline, and avoid the emotional traps that derail most investors during volatile periods. The cycle may have years left to run, or it may face a significant correction before continuing higher. You don't know, and neither does anyone else. What you do know is that the monetary fundamentals supporting metals remain in place and are likely strengthening. That's enough. That's your edge. Use it by staying calm, staying disciplined, and letting the cycle unfold without trying to micromanage every move. If you don't currently own gold or silver, you're probably wondering what to do now. First, understand you're not late to everything. Markets move in waves. Within long-term cycles, there are corrections, consolidations, and opportunities. The worst thing you can do is rush into a decision because of price action or fear of missing out. Your first job is education. Before allocating any capital to metals, you need to understand what you're buying and why. This isn't a stock where you're betting on management quality or revenue growth. This isn't a bond where you're analyzing credit risk and duration. This is a strategic allocation to assets that serve a specific purpose in a diversified portfolio, purchasing power protection during periods of currency debasement and monetary uncertainty. Do you need that protection? That depends entirely on your situation, your age, your net worth, your other holdings, your risk tolerance, your time horizon. All of these factors matter. A young person with decades until retirement, with most wealth and human capital, earning potential, rather than financial capital, has different needs than someone approaching retirement with most wealth and savings and fixed income. Someone who lives in a stable economy with relatively sound monetary policy has different needs than someone in an emerging market with currency instability. These are individual decisions. But here's what's universal. Rushing into any asset class because it's moving is almost always a mistake. Markets reward patience and punish impulsiveness. If you decide metals belong in your portfolio, the question becomes how much and how to enter. For most diversified investors, metals represent somewhere between 5% and 15% of total portfolio value. Some go higher, some lower, but that range captures most thoughtful approaches. How you enter matters as much as whether you enter. Lump sum purchases at current prices expose you to maximum short-term volatility risk. Dollar cost averaging, buying in tranches over time, reduces that risk at the cost of potentially higher average prices if metals continue rising without significant pullbacks. There's no perfect answer. There's only the answer that lets you sleep at night and stick to your plan through volatility. Physical metal versus paper claims is another critical decision. ETFs and mining stocks provide exposure with liquidity and convenience, but they introduce counterparty risk, regulatory risk, and in the case of miners, business risk that has nothing to do with metal prices. Physical metal is cumbersome. It requires secure storage. It's less liquid than paper alternatives, but it provides the actual monetary insurance that matters most if the system faces serious stress. Many investors split the difference, holding some physical for insurance and some paper for liquidity and trading flexibility. This makes sense for many situations. What doesn't make sense is making these decisions based on what prices did this week or what some personality on the internet predicted. These decisions should be based on your understanding of the macro environment, your assessment of monetary risk, and your personal financial situation. If you don't feel you understand these factors well enough to make an informed decision, that's fine. Take your time. Keep learning. The opportunity isn't disappearing overnight, and the risk of buying something you don't understand exceeds the risk of missing short-term price moves. Let's talk about the mistakes that derail most people during these markets. First, don't chase prices. Just because metals are up doesn't mean they'll continue straight up. Markets pull back. They consolidate. They test investors' patience. Buying only when prices are rising and selling when they fall is a perfect recipe for buying high and selling low. Don't use leverage. Some people see metals moving and think using margin or leverage will amplify their gains. What it actually does is amplify your risk of getting stopped out during normal volatility. Metals are volatile enough without adding leverage. The people who hold through entire cycles almost always hold physical or unleveraged positions. Don't make this your entire portfolio. Metals serve a specific purpose. They're not designed to be your only holding. Over-concentrating in any asset class, metals included, creates unnecessary risk. Diversification isn't a guarantee of profit, but it's a basic principle of risk management that serves investors well over time. Don't follow online hype. Social media is full of people making extreme predictions about metals. Some of these people are sincere but misguided. Others are selling something. Very few are sharing measured, thoughtful analysis. The signal-to-noise ratio is terrible, and trying to trade or invest based on trending narratives is more likely to hurt than help. Don't ignore the tax implications. In many jurisdictions, precious metals are taxed differently than stocks or bonds. Understanding the tax treatment of your holdings matters for overall portfolio management. Making decisions without considering taxes is planning to give away returns unnecessarily. Don't talk yourself into complexity. Some people approach metals and immediately start researching mining stocks, option strategies, leveraged ETFs, futures contracts, and exotic trading approaches. For most people, this complexity adds risk without adding value. Simple direct exposure to physical metal or straightforward ETFs is usually the better approach. Don't panic sell during corrections. If you buy metals with a long-term thesis, short-term price declines shouldn't trigger a sale. In fact, corrections in ongoing bull markets often provide opportunities to add to positions at better prices. The investors who succeed through these cycles are the ones who stay calm during volatility. Don't buy because everyone else is. Markets often move most dramatically when the public finally pays attention. By the time your barber is giving you gold tips, you might be closer to a top than a beginning. Independent thinking, based on your own understanding of the fundamentals, serves you better than following the crowd. Don't assume straight line moves. Even in powerful bull markets, prices don't go straight up. They advance, they retreat, they consolidate. They test your patience and your conviction. Expecting smooth, predictable gains sets you up for disappointment and emotional decisions. Don't neglect your broader financial health. Metals are one component of a sound financial strategy. They don't replace emergency savings. They don't replace adequate insurance. They don't replace paying down high-interest debt or saving for near-term needs. Get the basics right first, then consider strategic allocations to metals. Let me share how experienced investors approach this environment. They think in probabilities, not certainties. They don't know where metals will be next month or next year. They assess the likelihood of different scenarios based on fundamentals, position accordingly, and remain flexible as conditions evolve. They understand that being right about the big picture doesn't guarantee being right about the timing. You can correctly identify a major cycle and still face years of frustration if you're early. Patience isn't optional in these markets. It's the primary skill that separates successful long-term investors from everyone else. They focus on what they can control. You can control your allocation size. You can control how you enter positions. You can control your security and privacy practices. You can control your emotional reactions. You can't control where prices go tomorrow or what central banks decide next month. Experienced investors spend their energy on what they can influence and accept what they can't. They maintain balance. Yes, the macro case for metals is strong, but life continues. Businesses still operate. Most people still go to work, raise families, and pursue their goals. The existence of monetary risk doesn't mean the world is ending. It means certain asset classes become more or less attractive. That's all. They avoid the echo chamber. It's easy to spend all your time reading metal-focused analysis, listening to metal-focused podcasts, and following metal-focused personalities. This creates a distorted view where everything confirms your thesis. Experienced investors seek out diverse perspectives, including those that challenge their views. This makes their thinking sharper and their decisions better. They plan for multiple scenarios. Maybe the metals bull market continues for years. Maybe it faces a significant correction first. Maybe inflation accelerates more than expected. Maybe deflation surprises everyone. Experienced investors don't bet everything on one outcome. They position to do reasonably well across multiple scenarios. They separate investing from their identity. Your portfolio positions aren't who you are. Being right or wrong about metals doesn't make you a better or worse person. This emotional separation is crucial because it allows you to change your mind when facts change, admit mistakes, and adjust positions without ego getting in the way. They understand opportunity cost. Every dollar in metals is a dollar, not in something else. Is that the right trade-off for your situation right now? That depends on your assessment of relative risk and opportunity. Some periods favor metals. Others favor stocks or real estate or bonds. Being honest about opportunity cost leads to better portfolio decisions. They take a multi-year view. Monthly or quarterly performance is noise. What matters is whether your portfolio is positioned to preserve and grow wealth over 5, 10, or 20-year periods. This long-term perspective helps you avoid overreacting to short-term volatility. Most importantly, they never stop learning. Markets evolve, economies change, policies shift. What worked in the 1970s might not work exactly the same way now. Continuous learning, staying curious, remaining humble about what you don't know, these habits serve investors across all market conditions. We're living through a period of monetary history that will be studied for decades. The decisions made by central banks and governments in recent years have created conditions that don't resolve easily. The debt levels, the currency creation, the distortions in capital markets, these are not problems that vanish with a policy tweak or an economic recovery. They're structural issues that will play out over years, possibly decades. And throughout that process, hard assets like gold and silver will likely play a significant role for many investors. You don't need to have all the answers. You don't need to predict exactly how this unfolds. You need to understand the basic dynamics at work, assess them honestly, and make thoughtful decisions about your own situation. For those who hold metals, your job is discipline. Stick to your plan, manage your emotions. Let the cycle unfold without trying to micromanage every move. For those considering metals, your job is education. Learn what you're buying and why. Understand how metals fit into a broader strategy. Make decisions based on fundamentals, not price action or fear. For everyone, the job is the same as it's always been. Stay informed, think independently, manage risk thoughtfully, and maintain perspective. The financial landscape is shifting. That shift creates both opportunity and risk. The investors who navigate it successfully will be those who understand the forces at work, who maintain emotional control, and who think in years, not days. This isn't about getting rich quick. It's about understanding monetary cycles, respecting history, and positioning yourself thoughtfully for an uncertain future. The metals are moving. The fundamentals support that move. How you respond is up to you. But whatever you do, do it with clarity, do it with discipline. Do it as part of a broader strategy that reflects your goals, your timeline, and your understanding of the risks and opportunities ahead. Because at the end of the day, that's what separates thoughtful investors from the crowd. Not perfect timing, not lucky picks, just clear thinking, emotional control, and the patience to let long-term strategies work. The cycle is unfolding. The question isn't whether you predicted it perfectly. The question is whether you understand it, whether you're positioned appropriately, and whether you can maintain discipline as it plays out. That's what matters. That's what always matters. Stay informed, stay disciplined, and think long-term. That's how you win at this game.